nandito po tayo ngayon sa ADB dito sa Ortigas na kung saan ay gaganapin ang 2 araw na conference, Greening Financial Systems and the Rule of Multilateral sa mga directors kung ano po kanilang nais na parating para po sa climate change.
Green Analytics and Green Investment Group, Machuarie Asset Management, and I think it is he's already online. And let me just quickly look at and how I can introduce him. And actually, Mr. Barnes has been with the Machuarie Green Investment Group called GIG, and since joining the UK Green Investment Bank in 2013. And acquired by Machuarie to form GIG, Machuarie Green Investment Group in 2017. So it was sold in 2017, and GIG is now part of Machuarie Asset Management, the world's largest infrastructure asset manager. So let me ask Mr. ADRIAN Barnes and to present. And ADRIAN, are you there? Oh, I see ADRIAN.
Yeah, kind of brief summary of some of the points on the Machuarie Group, which is an international organization. So this is one of the major changes of since UKG.
Next, I'd like to touch on a slightly different subject, and that is the role of an international financial institution such as the Asian Development Bank and how it can support, or how we can support climate challenge and address some of the topics in this conference. I would like to therefore share some views on 3 areas. The first one is supporting regional supervisors. Second one is more on supporting supervisors' contribution to scaling up green finance. And third, ADB's role in supporting climate investment. And you may have heard a little bit on this before, but I think it deserves a little bit more discussion. So let me start by supporting regional supervisors. There are 4 such recommendations. First recommendation is on assessing and identifying climate risks for domestic financial institutions and the financial system. For that, supervisors need to develop a clear understanding of the sources of climate risk in their financial sectors. And of course, the transmission channels, the transmission mechanisms of climate risk to the economy and to the financial system. Methodologies are being developed to assess climate risk for the financial sector, and these still need to be further developed, fleshed out. And often what many of you will realize is that there is a scarcity of data. That makes things even more challenging. That doesn't stop us from building databases and being able to invest more in that. In addition, past observations are limited use in the context of climate change. We can't look at history as a determinant of the future. This is something new. This is a shock to the system. However, methodologies and data are constantly improving and already provide useful guide and information for supervisors as well as financial institutions. Turning to the second recommendation, it's about developing and implementing climate risk management expectations for supervised financial institutions. This is a very important element. As you know, financial institutions' ability to manage climate financial risk is paramount to the resilience of those risks. Yet we know from survey work, initial surveys of risk management practices highlight that financial institutions are really not yet prepared to manage those climate risks. And I think that's an important statement. Sometimes it may be considered a bit of a sweeping statement, but I think that there's a lot of merit in that. And largely it's because of what I mentioned before. The processes are not there, data is weak, and even tools need to be developed. So these are all important considerations as you look at what can be done in your countries. Now, against this background, international supervisors bodies like the NGFS that I mentioned earlier, as well as the Banking Committee for Banking Supervision, recommend setting supervisory expectations, again, going back to managing those expectations. So setting up supervisory expectations for financial institutions. And these need to be looked at. They should cover such things as governance, business and risk management strategies, but also such things as what we're doing at ADB, looking at scenario analysis and how scenario analysis can change, and even looking at stress testing of the portfolios, as well as, of course, increasing disclosure of such climate risks. So that's all in some ways important work that's ongoing that builds up that ability to better identify and assess those risks. International supervisory bodies also recommend engaging supervised entities in implementation of the supervisory expectations and, when needed, of course, mitigation measures. Let me now turn to the third recommendation. That's about support and implementation of climate risk disclosure frameworks for firms. So public disclosure by financial institutions of information related to their climate and environment risks significantly contributes to market efficiency. It ensures that market participants are, as well as supervisors, have adequate insight into the risk exposures, risk assessment processes, and capital adequacy for financial institutions. If I'm a financial institution and I'm lending to the next coal-fired power plant, you know, there's a reality that over the life of a 20, 30-year lifespan, you may be stuck with some stranded assets, right? How does that follow or reflect on the balance sheets of the financial institutions? So this is a very important consideration. Several disclosure frameworks and guidance are indeed available to financial institutions, such as the Task Force on Climate-Related Financial Disclosures recommendation. We at ADB published our first one last year, our inaugural report, and it was very enlightening to have the whole conversation, discussion leading up to that publication. We are committed to preparing our second one for next year. There are also, in addition to the TCFD, we have the International Sustainability Standards Board and the draft non-financial reporting directive by the European Commission, among others. Supervisors want, of course, to help define such standards, and that's obviously the role of supervisors, and to ensure that the metrics they require are relevant for their task. And in this context, the disclosure of the transition plans is, of course, gaining increasing traction as key information about both the transition risk exposure of firms and their contribution to the transition process is shared with greater market participants. Fourth and the final key recommendation that I'd like to highlight is to implement appropriate climate risk mitigating actions. So, as many of you know, at the micro-prudential level, climate risks must be accounted for in Pillar 1 capital requirements, and the Basel Committee for Banking Supervision has published, of course, guidelines on how financial institutions can implement these. Under Pillar 2, additional capital could be required for banks with inadequate climate risk management. Again, I don't know across many of our countries, developing member countries across Asia and Pacific, how far that discussion has happened or has taken place, but that's something that we need to continue to discuss. Climate risk mitigation measures can also be part of the macro-prudential policies as more and more supervisors acknowledge that climate risks are potential systemic risks, and therefore supervisors could engage systemic and concentration buffers as possible options. Let me now turn to the next item, which is supporting supervisors' contribution to scaling up green finance. So again, given the financing gaps that I mentioned earlier, there is a very important role of financial institutions to help mobilize those resources. So supervisors highlight that early and orderly action, which strongly limits the global temperature increase, is by far the best scenario for financial stability. Scaling up green finance is, of course, necessary, and we're doing that at ADB. And supervisors may wish to contribute to this in several ways. I think first, as economists, we recognize that incentives through regulatory requirements is a very powerful mechanism if done right. Financial regulators could reflect climate environmental considerations to support the greening of finance in the different regulatory tools at their disposal, such as, of course, regulatory capital requirements. One option suggested in this context is to support the green finance by reducing capital requirements for loans that fund projects aligned with transition to a net zero economy. This is the so-called green supporting factor. Alternatively, and perhaps a little bit, excuse me, a little bit more under question is can supervisors increase capital requirements for loans and projects that work against this transition? So going back to the point I mentioned earlier. lending to, say, a coal-fired power plant. Some financial authorities, like Hungary's central bank, have started experimenting with such schemes. However, at this early stage, empirical evidence is not yet available on the effectiveness of such schemes. They also raise concerns about side effects on financial stability and spillovers across jurisdictions. I know also a number of countries in Asia Pacific are also undertaking some pilots on this. Second, by supporting disclosure frameworks and sustainability reporting standards. Disclosure is indeed crucial to mobilizing investment for a transition by raising the visibility to investors in terms of opportunities in the low carbon space. So there's a lot of potential interest by private investors, but there's a lot of risks. And how can either financial institutions, international financial institutions rather, can help in terms of removing some of those risks, and we'll talk on that a little bit later. So for this, the disclosure frameworks should provide information on the contribution, possibly negative, of firms and projects to the transition, notably through disclosure of their transition plans and impact on climate change. So we'd like to see more and more financial institutions sharing those transition plans. Supervisors should also support such global disclosure frameworks, which increase, of course, the transparency to investors. That will help, of course, improve investment decisions and, amongst other things, reduce the risk of greenwashing. The ADB, of course, is contributing to this, and with this work, we are very much supporting climate-related financial disclosure. Third, through coordination with other authorities, supervisors are not able to be the sole or leading players in addressing climate change. Coordination between the government authorities is necessary, of course, to implement a comprehensive policy mix that allows the economy to enter a more virtuous cycle that significantly curtails emissions growth, boosts economic growth, and enhances bank stability. So we've got to get those policy decisions right to get into that virtuous cycle. Alongside supervisors, again, the Asian Development Bank is pleased to be able to work with other multilateral development banks to support coordination of such packages. Let me now turn to my final point, which is about ADB's role in climate investment. Again, we see tremendous opportunities, and as the climate bank in the region, we need to step up. Others are stepping up, and it's good to see that change happening. I think that as part of an IFI, I've been in this bank for many, many years. In some ways, I've never seen the excitement and the interest of working with ADB in this case in very many new areas for us. But we're here in the region and we need to engage with others in this quest. So IFIs such as ADB have a key role, as I said, in terms of climate investment, both in terms of mitigation and adaptation. Adaptation in many instances is the harder one. Of that $100 billion that I've mentioned earlier, we've got about 2/3 going into mitigation, 1/3 going into adaptation. Over the years, ADB has expanded and refined its toolbox of instruments in support of climate finance, bolstering its claim to serve as the, again, climate bank for the region. In addition to the level of ambition on climate financing that I mentioned earlier, the $100 billion, we're also committed to developing transformational policies through such things that Junki mentioned earlier, the climate change policy-based loans as a dedicated instrument. The idea is to work with countries to be able to see how we can reach those net zero goals. Countries have already determined their MDBs, and we need to make sure that we're able to follow pathways that indeed deliver on those net zero goals and on time. So there's a lot of work that can be done in this area, and the policy-based loan helps to remove some of those distortions that exist in terms of policies across many sectors, energy, it could be agriculture, and through the removal of those distortions, we can attract more private investment, amongst others, into these areas. The financing of policies outside of PBLs also is very important, and we've had a lot of discussions on such things as the financial intermediation lending modality. There's a lot that can be done, as you've heard also earlier today. In addition, ADB has recently launched a very innovative debt financing vehicle called the Innovative Finance Facility for Climate in Asia and the Pacific, also known as IFCAP. It was recently approved by our board, and we launched it at our annual meeting 2 weeks ago. IFCAP provides an innovative means to partner with countries to be able to provide much greater financing for, in this case, climate change. What it does is basically it builds on guarantees provided by contributing countries that will indeed allow us to free our headroom and allow us to be able to leverage on those guarantee mechanisms to deliver more financing. We were talking this morning about the ratios. With IFCAP, for every $1 in, we are likely to get approximately $5 in leveraged investment, so catalyzing resources. So that's a very powerful means that we have. It's also what we refer to as a public good. We very much would like to see other IFIs be able to build on this work. In addition to direct financing, of course, ADB is scaling up efforts to catalyze third-party public and private climate finance. And we've got an office of PPP that is also contributing strongly to this work. In terms of unlocking private climate finance flows at scale, we have many other instruments. We have, of course, our PCS, our preferred creditor status, that allows us to do a lot of interesting work, including syndication. We have the ability to act as anchor investments, given the long-term financing that we have, and also in terms of helping to support the markets through sustainability bonds, for example. Blending, leveraging grant resources is also a very important point. If we can blend to be able to catalyze more, why not? And we've got a lot of initiatives in that area. Risk mitigation, such as political risk and credit enhancement products, are also part of the toolkit. We could go on. We, again, mentioned earlier creating enabling environments across countries, looking at strategic partnerships, including with GFANs, and of course capacity building that was raised earlier on greening financial systems. So these are all part of the kind of the broader toolkit that we have at our disposal. And of course, events like this where we can convene experts, we can convene government officials, regulators, and exchange ideas. So all very powerful. These issues, of course, will all be explored and discussed further during the roundtable and into tomorrow's sessions. So with these thoughts, if I haven't put anyone to sleep yet, I feel happy. If not, I'm sorry about that. Let us now move to the panelist session and listen to others and their perspectives on why financial institutions need to be front and center in understanding and assessing the climate challenges, and also in terms of the solutions on how to mobilize funding through financial markets and support the greening of our economies. With this, I wish you a very productive and enjoyable conference. Thank you very much.
Actually, when you look at the impacts of climate change and we look at the different scenarios, that would again depend on the country context. I mean, the level, your economic status, your contribution to GHG, global GHG emissions, and your level of climate risk. We've run some stress testing, extremely rare typhoon event. The impact on the GDP growth will be systemic. But the capital and the banking system will be able to manage it, considering also the reforms implemented in the past. But I guess having said that, beyond, again, the scenario stress testing analysis that we're conducting, the policy framework should be robust as well. For instance, as prudential supervisor, the policy framework first should be aligned with national government aspirations and commitments. We cannot say that you have to go green or promote sustainability agenda if, say, the energy plan is not aligned with this one. Second, we have to have that mandate to implement it. Since we recognize that this risk poses serious safety and soundness concerns on individual financial institutions and to the financial stability, then we have to manage this risk in the financial system. Third, we have to issue regulations that are proportionate and strikes a critical balance between promoting effective risk management and then allowing financial institutions to actually see the opportunities in adopting the sustainability agenda.
Thank you very much. Good points. Maybe that's a segue to a question to Chris, Bank of England. How you mentioned a little bit the role of government and how it can facilitate that transition planning. To what extent do the supervisors need to speak louder to governments to help that process, or how do you see this unfolding as we move forward, and bearing in mind the points that were raised earlier on this transition pathway?
So, as both the institutions and the system make it clear to government what some of the risks are of different transition pathways, and that's what we've done. That's what we've done in the UK. So we've flagged what I think governments already know, that if you've got a deadline for getting to net zero, the sooner that you get to the sooner that you start to transition to net zero, it's likely that the lower the risks will be. So we're working with government on that. But there's a number of different ways that we can have useful engagements with governments. A really key one, and the UK will not be unique in this, is that in order to deliver some of the structural changes that we need in our economies, you need a patchwork of different institutions to undertake the role. So in the UK, what we're looking to do is is to embed a sustainable disclosure framework that will significantly increase TCFD-aligned disclosure and likely ISSB disclosure in the future. To do that, we need government to make changes, we need the listing authority to make changes to those firms that are listed, we need the prudential. It's very important that those like us that have the ability to see where those impacts might be coming, speak to those that have the policy powers to be able to mitigate those issues coming, so they can then take that action. Really good example of this is that it's likely that as floods increase, the cost of mortgages and the cost of insurance of properties in flooded areas will also increase. That could actually have an impact on the equality of mortgages, which can actually have a social impact. We cannot make policy to impact that. It's not for us, but it's our responsibility to speak to governments so they know about this and they can take appropriate action using their powers. So yeah, I think dialogue across a number of different areas is not only nice to have, it's absolutely essential.
Thank you very much, Chris. Thank you for those points. I have a next question, which is, I'm going to go a little bit off script, and if that's something that makes sense to you, please let me know. But one of the points that we haven't discussed too much about is the data that is required for the modeling on the part of the banks in the Euro system. I guess that is something that is important, and I guess like many areas we're looking at constraints. Is there anything that you would like to share with our representatives from BSP and Bangladesh Bank in terms of how do we look at the data question? What any tips, any lessons? You don't have the data. Do you work with some more generic data? How do you build that whole process? We haven't touched that. I know sometimes it's not as sexy as other things, but any thoughts on that, Livia?
No, thanks for the question. I hope you can hear me because actually I have some connection problems. I don't see your videos.
We can hear you, but we can't see you.
Okay. Sorry for that. No, I mean I connected from the office. So in theory, there shouldn't be any network problem, but I don't know. Anyway, I hope you can hear me anyway. So the risk that the data problem is used a little bit as an excuse. So on the one hand, one should not overemphasize the data limitations that are there, because if you look hard enough, data is in particular on scope 1 and scope 2 emissions, are now widely available. There is a variety of sources. So I don't think that there should be a kind of a crippling, factor. But there is certainly an issue. There's certainly an issue with scope 3 emissions measurement. We see it even in our own institutions. I mean, even in in central banks, it's hard to measure scope 3 emissions. And generally, there is a big issue of data harmonization. So different jurisdictions have different data and so forth. So my impression is the problem is more a question of harmonization and simplification rather than enough to discuss.
All right. Thank you.
Data. Because again, so if you look hard enough,
Okay, I think
data and the relevant data. The question of lack of data necessarily, but I don't know about the emerging markets, to be honest. So it may be different in the emerging markets.
Okay, I think we got the gist of your points. It faded away a little bit at the end, but yeah, I think it's the lesson is not to feel that you can't do much, and obviously not to be the pretext for not trying new things. My last question then goes to Fernando. Again, from a financial stability perspective, any new ideas that are coming into that framework on the part of supervisors that support the transition policy? Any kind of new thinking that may still be work in progress that is worth sharing in this forum?
Okay, thanks for this. Of course, supervisors have a genuine interest in sort of contributing in their mandates, of course, to facilitate a smooth transition towards a sustainable economy, basically because this obviously supports the financial stability goal. That said, I think my conviction could be very too orthodox on this. I believe that the best contribution the supervisors or regulators can do in order actually to facilitate this transition is precisely to preserve the safety and soundness of financial institutions, because this transition is going to require a huge reallocation of resources that could only be actually possible with an adequate contribution of financial institutions. But for that purpose, the financial institutions have to remain safe and sound. So I think it's not that we have to modify the current mandate of financial regulators. It's that we can even strengthen the dedication of financial regulators to this very basic and core objective of preserving the safety and soundness of financial institutions. And this is not actually sort of an easy task, as we have been discussing. There is much to be done. There are important changes that have to be adopted with respect to the regulatory framework, or more important, given the supervisory framework. And this is hard enough, actually, just to be able to develop the adequate adaptation of the current regulatory and supervisory framework in order to be able to preserve financial stability in the new context, in order for this framework to be able to address the huge actually challenges that climate development.
We bring this session to a close. Before doing so, I'd like to thank great panelists we've had. Mohammed Khurshid Alam from Bangladesh Bank, Lynn Javier from BSP, Livio Straka from European Central Bank, Chris Fink, Bank of England, Fernando Restoy, FSI. Thank you so much. It's been a very stimulating time. We've been able to get a lot of good insights from everyone. I pretty much enjoyed every minute of it. I wanted also to thank all of you, all the participants, for joining us. I'm sure there's a lot of...
Let me welcome the Chief of Finance Sector, Joo Kyu Lee, for a short recap of day one and look ahead of the events today. Thank you.
We had a very good session today and a lot of good topics.
Miss Horizon, kailangan ka maghanda kasi ang ating Pilipinas ay pwedeng bisitahin Bagyo, Lindol, pagsabog ng bulkan at tsunami. Maghanda ka at patitinan ng mga mahal sa buhay at isama mo na yung mga listeners.
Miss Horizon, ito sa ating project Maghanda.
Miss Horizon Chaser. Well,